Greetings, it is time for our monthly monetary update. This Yardeni report was delayed because apparently their data source had been hacked. So this report is a couple weeks later than normal, but that's okay. We will get back into the new month pretty soon nonetheless. So as always, we scroll down. And these are the four major central banks of the world: the US Federal Reserve, the European Central Bank, the People's Bank of China, and Bank of Japan. And for all the screeching you hear in the US media about how the Federal Reserve has printed so much money and therefore we will have hyperinflation, or even worse, already have hyperinflation, the US is just about 1/4 of total world money printing. And it's not even the biggest printer. It's the joint biggest, but Europe was in fact higher than the United States until Europe deprinted more. So the Federal Reserve has done $8.5 trillion of cumulative printing, but all four central banks are deprinting, as we're about to speak about. So everything you see in the US media about the Federal Reserve's money printing being excessive, that is not true at all. What they are doing wrong is overshooting in terms of their deprinting, as well as doing too narrow of a type of printing, only buying treasuries and mortgage-backed securities, thereby distorting those two asset classes versus what I recommend, which is sending cash directly to people, because a certain amount of money printing has to be done anyway just to offset deflation. It certainly does not cause inflation, as we will see later in this video. Now, since money printing is borderless and technological deflation is also borderless, the only thing that matters is the sum total of these four central banks. And this is not the entirety of world money printing, but it's about 85 to 90% of world money printing. So this is the best we've got in terms of tracking these four. So the sum total of these four is in this chart here. And as you can see, there is a distinct exponential upward trend, which is what you would expect given that more of the economy is converging from low tech to high tech, and technology is deflationary. Therefore, the amount of deflation being generated by technology is rising exponentially, requiring an ever-rising amount of money printing just to offset that technological deflation. Yet why are they deprinting right now? There is no aberrant inflation, as we'll see later in this video. They're deprinting under an expectation that there could be inflation because they're reading textbooks that are 70 years out of date. And by deprinting this much, they're going to cause a major stock market correction, a real estate bust, and a recession. As per this exponential trend line, they should be here, not here. They're already 6 or 7 trillion behind. If this has to catch up within 2 years, that would involve more than 10 trillion needing to be done over a 2-year period just to go from here to here. Now we take this same chart and see what is the year-over-year growth rate. Now I claim the year-over-year growth rate of money printing just to offset technological deflation has to be in an equilibrium of 16 to 24% a year. And it rarely even gets into the bottom range of that zone. It usually goes into that zone for a little bit and then it goes below, because this economics establishment is more worried about inflation than anything else. And they would rather have millions of people lose their jobs even before they see any evidence of aberrant inflation, which never shows up anyway. That's why whenever they tighten, they're forced to do more just to catch up because they've crashed the economy, and then they think they've done too much even though there's no real evidence showing that they've done too much, so they overcorrect again, and now they're negative. They're at minus 10.2% year-over-year growth in the amount of world money printing. During the peak of COVID-19 quantitative easing worldwide, which was February of 2021, almost 2 years ago, this year-over-year growth rate was as high as 46.3%. That was above that zone of 16 to 24% that I mentioned. Even I thought there could be aberrant inflation at this level. So we had a few months of slightly above normal inflation, which has already corrected back down, as we're about to see later in this video. And now they're overshooting again. They should never be going negative. They could have just very gently got back into this equilibrium range, but now they're overshooting again, so they're going to overshoot yet again. These central bankers are behaving like amateur day traders because they're acting in a reactive way. They act too late, and then they overshoot the objective, so they have to overshoot again. This destroys all decision making across the economy. And now for the last chart that we usually look at in these monthly videos, this is the amount of quantitative easing relative to the GDP of the country or cluster of countries doing it. For all the screeching you hear about regarding the US Federal Reserve printing so much money, it's actually the joint lowest of the four. It has printed only 34.3% of its GDP since the very beginning, over all these 12 or 13 years of QE. It is the joint lowest of the four. Only the People's Bank of China is about the same. The European Central Bank has done twice as much. They're at 65.6% of their GDP. And you would think Germans are the ones who are the most afraid of inflation and money printing, but even they have done twice as much as the US. And remember, GDP is an annual metric, and this is the cumulative amount of printing over many years, 15 years. QE really began in earnest in late 2008, as we can see here. But the grand prize of money printing goes to Japan. Japan has done twice as much as Europe, and thus 4 times as much as the United States. They have done an incredible 127.6% of their GDP in quantitative easing. Yet even the people who falsely claim that the United States has very high inflation, even they don't claim that Japan has unusually high inflation, because Japan has been struggling with deflation for many decades before they decided to print a lot of money in early 2013. And guess what? It worked. They increased the net worth of many Japanese without having any domestic inflation. Now, of course, these country-level numbers are of limited value because only the worldwide total matters, because technology is also borderless. The amount of technological deflation can only be quantified worldwide, so QE has to be quantified worldwide. But I still highlight this to show how ridiculous the US media screeching is. They're creating a narrative of inflation because inflation sells. The Federal Reserve is a good bogeyman to vilify, and the Federal Reserve should be criticized for turning off printing and turning it back on and creating an impossible decision-making scenario in the US economy, and for printing money in the form of just buying treasuries and mortgage-backed securities rather than sending cash directly to people, which would be far more granular and diffuse. But to criticize them for printing in the first place is absurd because they are the lowest of the four and have done only 1/4 as much as Japan. Plus, the people who prefer this narrative tend to think that the United States is the only country in the world. They say that Federal Reserve money printing will cause gold to go up, even though gold is priced worldwide, whereas the Federal Reserve is the central bank of just one country, and a country that's done only 1/4 of the world's money printing. So now we go to my scorecard of the 2020's monetary creation prediction. I display this chart every month. On January 1st, 2020, I looked at the 2010s and saw that $23 trillion of money printing was done up to that point. The PhD economists of the world still believe that money printing can be undone. They have no understanding of the economics of software or technological deflation. They're not even curious about why their models, which are about 70 to 100 years old and therefore not relevant to a software-based economy, are out of date. And therefore they thought that the 2020s would comprise a reversal of the first $23 trillion of money printing that they did. Therefore their prediction of the 2020s is minus $23 trillion of printing. Whereas I said, no, technological deflation is exponential. If the 2010s had $23 trillion of printing, the 2020s would have $50 to $100 trillion of money printing, an exponentially rising amount as per that parabolic exponential curve that we already saw. The lower number, 50 trillion, is all that would be needed if it were done in the form of cash sent directly to people, which is what I advocate because that is less distortive, much fairer, much more granular, and prevents concentration of funds where it is needed the least. But if they continue with their bond buying program, then the number will have to be closer to $100 trillion. But even so, my prediction is 50 to 100 trillion. So philosophically, I'm saying it rises exponentially, and that's a good thing, whereas they still believe the first 23 trillion can be undone. So on January 1st, 2020, this is what they believed, deprinting, and exponentially rising printing is what I believed. So what are the actuals to date? We are now about 30% of the way through that 10-year period. We are into 2023 now. And what has been done so far to date in this decade is plus $7.8 trillion of money printing. So it's very much on track towards my number, not their number. Remember, this is exponential. So the halfway point of the decade will not have half of the printing. There'll be much more in the second half than the first, just because of the second derivative, the exponentiality of it. But PhD economists worldwide, the economics establishment who actually studies these things and society has entrusted to understand what's going on, continue to believe that this is what it will be. Because remember, they never face a penalty for having a wrong prediction. They have jobs of very high job security and are only surrounded with people who have memorized the same textbooks as they have. Now, what is the state of inflation after all of this money printing? For that, we go to part 2 of this video. The inflation data is from a couple weeks ago because, again, that Yardeni report was delayed, but it's still applicable for this month. So now we go to part 2. It is time for our monthly inflation update, and we're going to take a different format this time because I'm going to combine a concept that I introduced in another type of video from last month. But at any rate, we start with our 3 major inflation measurements to create a combined holistic view of inflation. This way we get around any objections that claim that the US CPI understates inflation and other such easily debunked beliefs, as well as a fixation on short-term numbers, which we'll also look at later in this video as to why that is futile. So as always, the measurements are the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index. This is the most important measurement of the 3 because this is both worldwide as well as an index of freely traded components such as gold, oil, natural gas. Therefore, it cannot be rigged. This whole narrative that inflation is understated is entirely destroyed when you use the Goldman Sachs Commodity Index. And then lastly, the 10-year US Treasury yield. This is not a measurement of past inflation. It is about expectations of future inflation, but it has a tremendous impact on the real estate market. So we'll go to the Goldman Sachs Commodity Index first. Flying through this really fast, we can see that the 10-year compound annual growth rate of the Goldman Sachs Commodity Index is minus 0.55%. Minus 0.55%, which means deflation. For all this talk of inflation, there is outright deflation in commodities, which is the most important of the 3 measurements. Next, we go to the 10-year US Treasury yield. This is the 10-year US Treasury yield, 1-year chart, and it's 3.50%. And as I've often said, it's very hard for this to stay above 3%. It is comparable to holding your arm horizontally to the ground and seeing how long you can hold your arm up like that for. It shot above 4%, but it couldn't stay there for very long. It has dipped back down to 3.5% because this is extremely negative for the housing market. And once the housing market starts to weaken, there's pressure on this to weaken, as well as all other inflation measurements to weaken. But this is the one that happens to be above 3%. Lastly, we go to the US CPI. US CPI from the bls.gov website. So to calculate the 10-year compound annual growth rate, you would take this number, 298, divided by the number exactly 10 years prior, which is 231. That shows 29% inflation over 10 years, which comes out to 2.6% a year compounded over that 10-year period. If you want to see the arithmetic about how that is done, look at prior month videos. But I want to fly through this because we don't want this video to be too long. So we take all 3 of the measurements we just looked at, and this is what we come up with. Today, on December 14th, 2022, the 10-year compound annual growth rate of the US CPI is 2.6%. The 10-year compound annual growth rate of the Goldman Sachs Commodity Index is minus 0.55%. Commodities continue to be in deflation as we would expect from the atom thesis. Technology continues to increase the supply of commodities at a rate faster than demand. And the 10-year US Treasury yield is 3.5%. And remember, inflation is problematic only when all 3 of these measurements are above 3%. All 3 have to be above 3% at the same time for inflation to be structurally high. And as you can see, only one of these 3 is above 3%. The others are not. And the Goldman Sachs Commodity Index is in deflation. It is nowhere close to 3% and doesn't look like it could ever get to that type of measurement. So no, inflation is not high at all, despite the narrative in the media. Remember, inflation sells, and the media makes money by making you angry or frightened, and they want to keep you in a state of anxiety because we're getting so many contradictory headlines. The fall in oil indicates a weak economy. So until the day prior, they were saying inflation is bad. Now a fall in oil prices is also bad. Their only constant is saying that everything is bad news. But this is the inflation scorecard, and I want to take you to a new type of table that I've introduced because people have an extremely short-term memory as well as an extremely selective window of data that they choose to look at in order to support a bogus narrative. So here we are back at the CPI measurement at the bls.gov website. In addition to the absolute CPI, we look at the growth rate over the various windows that can be measured. This is the 1-month growth rate that has fully moderated back down after the initial flurry that was very temporary, as I always said all along. The 2-month growth rate that is also moderated back down. The 3-month growth rate that is also moderated back down. the 6-month growth rate that is already halfway down to its normal zone, and the 1-year growth rate that has already peaked and is starting to go down. And everyone looks at the 1-year growth rate because that is apparently the only window of time that matters. When the 1-year growth rate of the US CPI is high, then people say that inflation is high, but when the 1-year growth rate is not high, then the same people are nowhere to be found. So let's take an annualized standardized measurement across all of these various time snapshots to get some uniformity. So this is a table that I introduced last month, and I've updated it for this month. As we saw, the 1-month inflation growth rate is 0.1%, but if you take that up to an annualized measurement, so to the 12th power, you get 1.2%. The 2-month growth rate is 0.5%, but if you take that to a 1-year annualized growth rate, which is to say to the 6th power, you get 3%. The 3-month growth rate is 0.9%, but annualized, that is 3.6%. The 6-month, which we saw, is 2.4%, annualized 4.9%, and the 1-year growth rate is 7.1%. It happens to be the highest number in this entire table because any time window less than a year shows much lower inflation than the headline media would have you believe. And any time frame greater than a year also shows a low annual inflation rate. In fact, the 10-year, as we saw, which is just 2.6%, also is followed by the 5-year, which is 3.7%, and so forth. So only right now is the 1-year inflation rate high, even though it's already past its peak. It used to be 8 point something before, now it's down to 7.1. And obviously, it is very unusual for the 1-year inflation rate to be the highest within all these time windows. Usually the magnitude of the number might be very unevenly distributed among these time windows, and this red number, the 1-year, is getting pushed down to be within the zone of these others as well. In fact, the shorter term inflation is declining so quickly, that's why you have these lower numbers in the shortest window of time frame. If 1 month had only 0.1%, then a year has 1.2%, which is quite low. So despite everything you hear about inflation was 7.1% and it's raging out of control, no, nothing could be further from the truth. The peak was several months ago and it's already declining very quickly. So why is the Federal Reserve tightening still? Well, for that you'll have to see other videos on this channel. But no, inflation is not high, nor is it rising in a second derivative. It has already peaked and has been in decline for a few months already, and we are getting back down to a low inflation rate. In fact, we may even dip into deflation, and then the Federal Reserve will have to resume quantitative easing and lower the Fed funds rate again. But to be worried about inflation now is quite innumerate, and this data really reveals how that is yesterday's news, to put it mildly. Inflation peaked quite a few months ago and was never going to stay very high for a sustained period. As I have said all along, the atom thesis, the first principles of technology and economics, made this an easy prediction to make. The amount of money printing that can be done without aberrantly high inflation is much higher than people think, and we have just witnessed this over the last 12 years as well as over the last 2 years, and this will continue to manifest. Now, if you found this video to be informative and you like this type of content, then I encourage you to subscribe to this channel. Thank you very much for watching.